We still have people arriving, so thank you for your patience. We'll kick off shortly. So tihe moriora, ina mana, ina reo, ina rangatire ma, tena koto, tena koto, tena koto katoa. Arama, everybody, you're very welcome to today's webinar. My name is Brendan O'Connell. I'm the interim CEO of Agritech New Zealand, and great to have you all here today to look at the global landscape for Agritech investing. Really looking forward to this session, and great to see so many people joining us. We will be recording the session today, so if you've missed it or you want to let colleagues know about it, that will be available on the website in the next day or so. We'll be very happy to take questions during the session. So if you pay attention to the bottom of the screen, you'll see there's a chat function. Feel free to chat away there. But if you have questions, put them in the Q&A session down below, so you can chat between yourselves and put questions in the Q&A session. Now, to introduce today's presenters, I'd like to hand over to our Director of Global Alliances, Peter Van Hilton, who has such a rich history and experience both investing internationally and particularly with the team here today. So, Peter, can I hand it over to you?
Well, thank you very much, Brendan, and kia ora, everybody, particularly kia ora Arama and kia ora Ingrid. So for those few of you who have probably not met Arama and Ingrid before, a brief introduction. Arama is co-founder and partner at Finistere Ventures. Ingrid is investment director at Finistere Ventures. Both, I think, working probably from home at the moment. Arama is based in San Diego. Ingrid is based in Toronto in Canada. And it's fantastic to have you both on the call today to share what I know is really, I think we were calling it before, breaking news. You've actually got the most up-to-date data on the status of current Agritech investment. And I know it's a matter of huge interest here in New Zealand and also across the Tasman in Australia. And just like to say, good day to some of the Aussies who've joined this call. It's great to have you on it. But I'm really going to hand over now to Arama and Ingrid. But just before I do that, and I think we did this on our last call, just Arama, just first of all to ask you, what is life like in San Diego at the moment, just to create a kind of understanding as to how you're living in this kind of rather strange world in which we're based at the moment. You're on mute, Aaron. There you go.
Yeah, can you hear me now, Peter? Just
yeah, absolutely, yeah.
Yeah, kia ora tātou, everybody, and great to be here today. Peter, thanks for the introduction, and Brendan, likewise, for the warm welcome. Well, we live in interesting times. We are in a country that's, well and truly in the depth of a pandemic of really unprecedented scale, and yet, despite, I think, what everyone has probably already read and seen through media, and we'll cover today, it is also a really interesting time for the development and growth of the agri-food technology sector, which we'll spend some time covering off. But on a day-to-day basis, we're dealing with the practical matters of staying healthy and well, both ourselves and our team here, which is spread out globally actually, but also in pretty wide range of portfolio companies, who are all dealing with the challenges of getting to work day to day and staying fit and healthy and well in the process, which is not an easy task at the moment, as you've probably seen from the rising COVID numbers that we have here.
Thanks, Arama. And Ingrid, just very briefly, over to you. Obviously calling from Toronto. How are things faring in Canada at the moment?
We were doing pretty well earlier in the summer, but we've certainly kind of shifted to a new normal where Masks are mandatory in public spaces indoors. And it looks like, with the reopening of schools and the cooling down of weather here in Canada, we're probably headed towards, more COVID-related restrictions. But as Peter and I were joking a little earlier, thankfully the ski season's about to start. So we'll be able to get outside and at least enjoy the outdoors despite the Canadian winter. So looking forward to spending a lot of time outside despite the cold.
Great, thanks Ingrid. Well, I think that's an appropriate moment to hand over to you, Arama and Ingrid, to take us through your presentation. And just a quick reminder, as Brendan said at the outset, if you've got any questions, please post them in the Q&A session, and then we'll moderate those following the conclusion of the initial presentation. So over to you, Arama.
Yeah, thanks again, Peter. Great to see such an amazing gathering here. A lot of names just scanning through here that I recognize, a lot that I don't. So thanks for taking time to join us today. And again, thanks to Agritech NZ for the opportunity to share some of the information we've been putting together through our research, really over what has been about a 5-year relationship with PitchBook Data, one of the leading market research and investment research firms focused on the venture capital and private equity space. Some of you may be familiar with them. If not, they do publish an immense amount of really useful information free of charge off their website. But they also have, as their cornerstone product, a market intelligence platform that is tracking investment activity across literally hundreds of thousands of companies. The business itself is owned by Morningstar Financial, so some of you may know, the parent group that's also one of the world's leading sort of databases on financial reporting in the public markets as well. We started working with PitchBook Data about, as I say, 5 years ago, when, as we were looking to really get information about the key investing trends going on and what was clearly a segment that was really starting to break out and mature, that there was really very little reliable financial data that was organized in a way that helped investors like us. We're a venture capital firm headquartered here in California, investing into early through growth stage companies in the food and agriculture space. So being able to get reliable intel and up to the minute information was really not available even 5 years ago. And so we started working with PitchBook on essentially building a classification process and then really deep diving data, working with their analyst team to be able to produce some of the information you're going to see us walk through today. Also on the call here from Finistere is Candice Brown, who's our Chief of Staff and Event Manager. So I think we're going to pop up the presentation here and start walking our way through it. So the theme for today's discussion is not just sort of a recounting of statistics and facts, but also hopefully some insights into really tying back to your question, Peter, how are we going in the post-COVID world that we're now in? Well, how are we traveling from an investment standpoint in the agri-food space, given the very different world that we're in from when we physically shut our office here in San Diego on March 13th to where we are, which seems, by the way, like a lifetime ago in terms of just the amount of activity and work we've done over that period, but under very difficult and different circumstances. So we'll unpack this a little bit as well as we go through the presentation today. Maybe Candice, we could bring up the next slide. So I'll say a few words about this and also invite Ingrid to sort of add her color and context here. When we started this work, we realized we needed to also build out what I guess we call a taxonomy, really a fancy way of saying a classification system for better understanding in this giant horizontal that is agri-food, where is the capital flowing? And so the orange segment represents the ag categories, the blue, the food. And a big part of what Ingrid and other members of our team have actually been doing, and Ingrid is the editor of our report process and sort of leads our research effort in partnership with PitchBook, has been thinking about how to classify and effectively bucketize the different companies and investors that make up this incredibly active ecosystem. Ingrid, any comments you want to share with the wider group about the process we've gone through here, just sort of setting the scene before we jump into the data?
Yeah, for sure. I think one of the important things that we noted early on is that, despite it being a horizontal of related industry and segments, really there were a number of very, very different business models and capital requirements that existed within the agri-food ecosystem. So, for example, indoor ag companies and plant science companies and crop protection companies all really fundamentally have very different paths to market, have different challenges to accessing capital and executing on their business plans and business models. So one thing we noted once we started segmenting out all of these categories within ag were really the differences and dynamics between them, and how fundamentally, while they're all related to food production and getting food to consumers' tables at home, there's a lot of different requirements for each of these companies. So one of the things that we've done and are very, very proud of is starting to track, some of the differences in dynamics in capital funding, as well as investor appetite for putting capital into these different subsegments. And we'll share some of that information with you guys here today. Some of it's changed quite a bit in response to, the dramatic shift in our industry that has come with COVID, and others, have continued on strong, despite the tailwinds in response to COVID. So looking forward to sharing more of this information with you guys today.
Great, Ingrid. Let's go to the next slide here. So really a couple of headline points to note here. Firstly, 2020, despite COVID, and in some sectors, perhaps because of COVID, is set to be another record year for capital. And we'll unpack the trends here as we go through the presentation, but the headline number or numbers I want to bring attention to, firstly, is that year to date, at $11.6 billion US dollars in total capital flowing into agri-food, we're already in front at the end of Q3 where we were for the whole of 2019, which in turn was already a record year. In fact, back in February with Peter, we actually did a webinar, some of you may have been at that, where we actually looked through the 2019 trends. So remarkably, and I think despite perhaps concerns we had back in March around what COVID might do to the flow of capital, in fact, we are well on track to blow away the record 2019 numbers. And we'll talk a little bit about why we think that is here in a second. But it continues a trend over the last decade of accelerating capital deployment from what really was something of a specialty or niche category of capital investment in the venture world to something that is now sufficiently mainstream that, last week I was talking to the innovation team at BlackRock, the world's largest fund, that has a specific carve out for agriculture and food technology investing. So what we're seeing is a maturation of this sector, which I think is fantastic news for New Zealand and Australian entrepreneurs, for government, for the research institutions, and of course for established industry that are in this sector, because the capital spotlight has never been on this sector shining as brightly as it is today. It is frankly a period of unparalleled opportunity for global centres of excellence like New Zealand and Australia, like Ireland, like Israel, like Canada, and of course the United States, amongst others. This is a breakout moment for the sector, and it's truly global in scope. And so how do the dollars break out? Well, the trend continues that they break out approximately 2-to-1 food versus agriculture. So if you sort of think of, how is the split, it's sort of, 66% roughly to place 34% in terms of total spend. That number does move somewhat year to year, and there are reasons for that we can unpack. But if you look at the sort of general trend through the last couple of years in particular, it's been a phenomenal period for the maturation of this investment asset class. And of course, for those of you on the call here who are either investors or are backing companies in the space or are setting government policy, for example, around economic development opportunities, this is, again, I think a really exciting period in time for the agri-food space. Let's go to the next slide. So we're going to break this up between Ingrid and myself. You'll be relieved to know, it won't just be me talking. and we're going to have Ingrid take you through the AgTech numbers. I'm going to focus a little bit more on the food numbers, but I think one thing that we'll just say as well as we cover this is we'll also be looking at by stage as well as by sub-segment. The total amount of information we get as we work through this with PitchBook is truly gigantic. So we're not going to try and cover every single sort of last level of detail here in today's call, but hopefully give you enough of an overview that you can come away with a clear sense of the key trends in both of these related categories. So Ingrid, over to you on the AgTech.
Yeah, for sure. Thanks, Arama. And so I think Arama highlighted it really well. The overall impact on ag or agri-food investment, despite a global pandemic, despite, political and economic unrest globally, is that there is a continued upward trend in capital investment into agri-food. Specifically, when we look at, what the impact of COVID has been on AgTech investment, it's really had the effect of accelerating capital deployment into the segment. So AgTech investment so far in the first 3 quarters of 2020 has totaled about 3.07 or 3.1 billion or so. In contrast, compared to 2019, the entirety of the year only received 2.7 billion in investment. What's interesting is that total deal counts within the sector has actually decreased compared to deal counts across the same quarters last year. What we noted early on when the pandemic hit was that we saw an initial pause amongst our peer groups of investors in making new investments while they refocused internally and looked at supporting their portfolio companies through the impact of COVID. Allegorically, we see the effect of this with an increase in capital deployment in Q2 2020, as well as when we take a look at the capital invested by venture stage in 2020, you see that 82% of the capital deployed this year has gone into later stage deals, mostly follow-on capital, and allegorically, primarily based on insider rounds designed to extend the runway of portfolio companies past the impact of COVID into the end of 2021. When we take a look at the largest deals done so far this year, you'll note that companies like Indigo and Greenlight and Pivot Bio that are solidly on the life sciences side have benefited significantly from interest in investment into life sciences related companies brought on by the interest in investing in pharmaceutical and life sciences applications due to COVID. As well, you see interest in investing in companies that really impact the supply chain across agri-food. So Farmers Business Network is a company that's designed to disrupt crop inputs distribution. They raised a significant Series F at 250 million. And then a solid crop of indoor ag companies have been financed as well. So Finistere's portfolio company Plenty raised a 315 million Series C this year, designed to help them start bringing their products to market. And we think the interest in indoor ag will only continue as we continue to experience supply chain disruptions and limitations on access to fresh food in grocery stores due to just supply chain disruptions caused by COVID. When we take a look at where capital has been deployed by stage, as I said, 82% has gone into later stage deals, suggesting that investors are continuing in ag to focus on companies that are maturing and deploying the lion's share of capital here where risk has been mitigated either from a technology de-risking perspective or a business model development perspective. Next slide.
Ingrid, I'll just add one point, which is that notwithstanding that, for a lot of Australian and New Zealand companies that are either at seed or within PitchBook's parlance early stage, those are still really meaningful numbers of, large amounts of capital when you think about the base that it's been calculated off. And so from that standpoint, I think actually the trend towards later stage is not a negative signal for Australasian companies, because there are not that many companies that are at that stage that are raising $50 million rounds. There are a few, but not many. But there's still a substantial amount of money in absolute terms still flowing into early stage, just to make that point.
Thanks, Arama. Yeah, so it's important to note that median deal sizes, for early stage companies are smaller. So, there are a larger number of smaller size deals being done in early stage venture within AgTech compared to, a handful of what we're calling mega deals. So deals that are 100 million plus within the later stage deals for AgTech investment. When we take a look at, which AgTech subsegments have been invested in the most in 2020, it's clear that it's been a breakthrough year for indoor ag. So, across the first 3 quarters of this year, indoor ag has captured about 28% of the capital that's flowed into AgTech compared to around 11% in 2019. So really the interest in strengthening the food ecosystem against supply chain disruption has driven a lot of capital investment into indoor ag companies, which seem to be a potential mitigation strategy against some of the disruptions we've experienced. When we take a look at early stage pre-money valuations, they trended downwards compared to 2019. However, later stage valuations have remained steady. Once again, we think this is a reflection of the bifurcation of the types of deals that are being done in this in 2020, with later stage deals primarily being led by insiders who are unlikely to pull down valuations or shift valuations as much within this segment of AgTech. Indoor ag, as I said, has benefited significantly from tailwinds due to supply chain insecurity. The 28% of the capital that's been invested into AgTech translates into about a 1.24 billion of capital invested into the sector so far, with median pre-money valuations solidly in the mega deal size. So the median deal size of indoor ag companies that are being financed is around, in the later stages, around 110 million. When we take a look at early stage deals being done in indoor ag, they're significantly smaller, coming in with a median pre-money valuation of about 35.7 million. You'll also note that, as I noted in the previous slide, crop protection has also benefited from interest across in investing across biotech and life science innovations, and increased interest in driving sustainability in food. In response to COVID, the sector captured 1.23 billion investment so far in 2020, and we anticipate that this interest in driving sustainability, and as well as in the cross sections of life science and ag tech, will continue to grow, and this crop protection segment will continue to benefit from this interest. Across broader ag tech, the segments have been impacted differentially by COVID. Early stage pre-money valuations have trended downwards from a high of 22 million in Q4 of 2019 down to about 10.75 million in 2020, while later stage valuations, as I said, have remained relatively steady. And we expect that changes in valuations will be a little bit slower to be seen within AgTech because valuations tend to be a little sticky. So the true impact of COVID on valuations within Agritech investing will likely not be seen until early 2021, when investors go out to look for new deals to invest in, as well as companies that were caught unprepared by COVID, as those companies start to go out and raise capital in Q1 2021 as well. Next slide. And with that, I'll hand it off to Arama to tell you guys a little bit more about the food tech investment trends.
Thanks, Ingrid. One point I'd make just as well before we jump into food tech that I think really carried across both sectors is the amount of capital that flowed in Q2 of this year. Really, what I think of as sort of the COVID response from VCs in particular and from entrepreneurs was, amongst the most significant in total. It was the most significant quarter we've seen in the last decade. So a pretty extraordinary response. And I recall, having many calls with other VC firms that we had co-invested with a common theme. Now's the time that we need to think about pulling forward capital raise, if we can, to ensure that our companies have a strong buffer of capital to continue to both execute and to ride through what could be a very lengthy and extended and challenging period. And so guess what? We saw just really unprecedented amount of capital activity. We've done 11 financings this year, which I'd say is typically double the number of any other year of financings. And we saw this trend right across the space. In fact, that conversation continues, and there has absolutely been a have and have-nots scenario play out here in terms of who can raise capital as investors back their existing horses and made sure there was plenty of feed in the stable. So when we think about what that's meant in terms of acceleration of capital, is it a pulling forward of capital from 2021 into 2020, or is it also part of a bigger trend toward increasing capital flow into a sector that has been historically underinvested? And we think it's probably, based on what we're seeing, probably more the latter. But there is, because there's no question, there's a lot more players coming into the sector and more diversity. My comment about BlackRock just being one of many, 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 large traditional players looking at this specialist vertical and saying, gosh, there's a real there in terms of the opportunity for us to go and invest, especially as the check sizes get larger and the companies get later in stage. So just to give you that context, I think one of the key questions if I was a CEO running a company is what does the capital raise environment look like in 2021? And how do we really, perhaps particularly if we're trying to bring new investors in, how are we going to do that in the context also of not being able to travel to go and meet face to face? So, we haven't made an investment yet in a company that we've never met, but we're now weighing up, is that something we'd entertain doing in 2021? And I think it's almost certain that we and other professional investors in the VC space are going to be grappling with that question. And so if you're out there raising capital this year, next year, just really something to think about. How do you get over that threshold of not being able to meet companies face to face? So which will be an interesting conversation as we go forward into the new year. So onto FoodTech. FoodTech has become an increasingly important part of our investment mix. And I think one of the contrasts you can draw between this and AgTech is that where AgTech tends to be more B2B focused, the companies are typically selling into channels and into, for example, large farm cooperatives or retailers or OEMs. Food tends to be more B2C driven. And so typically what we see in our portfolio is that the revenue ramp is typically quicker in FoodTech. And one of the reasons why these companies need a lot more capital is that the go-to-market costs, particularly marketing and establishing and acquiring customers in that revenue, tends to be a pretty expensive exercise. In the US alone, there's 40,000 new CPG company brands or companies launched every year. And the vast majority of those are going to die on the vine. So, it's definitely a very different risk-reward profile to Agritech. That's sort of one of the points we'd note. And it's somewhat reflected, as I said earlier, in the amount of capital that is going into the space. Where the majority of the top deals in Agritech have become mega deals, all of them are mega deals in food. So in other words, the top 10 to 20 deals are $100 million plus raises. But it's interesting, if you're thinking about going from early through to that kind of growth stage, I think one of the opportunities that this pinpoints is that if you have a world-class team, technology, market opportunity, the capital is there. And frankly, the world is getting flatter in this sense, and even flatter on Zoom for Australasian companies to tap into this type of capital raise. We haven't seen too many examples of it yet, but I think it's just a question of time, perseverance, and application. Where are the dollars going in FoodTech? If you sort of think about the types of rounds that have been raised. So we've seen obviously an explosion in alternative protein, and particularly driven off the interest created by flagship, leading companies like Beyond and Impossible in particular. But we're also seeing a new wave of companies like Memphis and Perfect Day that are pursuing, so-called cellular or cultivated protein opportunities. Perfect Day in the dairy space, and Memphis Meats, which we're an investor in the cultivated meat space. Also continuing to drive huge rounds are the delivery companies, and particularly one has seen their growth driven by the trend towards dining at home. Maybe we go to the next slide, actually, Candice, because this will sort of segue into this point. But meal kit delivery and e-commerce companies have clearly benefited significantly from COVID. Tailwinds capturing nearly 60% of the FoodTech VC dollars, and with very significant movements and pre-money valuations. I know there's a school of thought that looks at alt protein as already being pretty frothy. If we look at the sort of valuations being demanded, they're to some extent also tied to the fact that these are very capital intensive businesses to win at. So if we go back to the Agritech side of this, with indoor farming, Plenty raising 300 million plus, and in total I think we've raised 500 million. At this point, we're building the facility we're building in LA, which is the world's first truly scalable vertical farm, is $70 million capex commitment. And if you look at what Memphis is doing, what Perfect Day are doing, they're to build relatively large scale production facilities requires a high capital intensity. So one of the challenges, I think, in investing into the space, but also the opportunity, is that as you get later, you're going to need very significant syndicate capital support. We're also seeing companies making early moves towards structured equity, debt, where it can be supported. And we're also, I'm sure you've heard, there's a SPAC boom going on here in the US as companies look to take advantage of pent-up demand in public markets for food and sustainability products, which they can't invest into if they're still held privately. So AppHarvest, for example, a greenhouse company, we don't consider them in this bucket because they're really not a technology platform company, but nonetheless, just raised nearly $500 million as they went public in a valuation of $1 billion, building 2.5 million square feet of greenhouse space in Kentucky, of all places, to grow tomatoes for the East Coast. I mean, they're phone book numbers, but it gives you a sense of the appetite that's taking place within the space. So, in addition to the alternative protein space, dining at home has really taken a significant boost. Companies that we're invested in on the top right-hand side, Farmer's Fridge and Tovala, which are both using hardware-enabled approaches to direct to consumer and dine at home, are benefiting from the fact that this is the most dining at home dollars seen since 1994. Over that last 25 plus years, every year restaurants, QSRs have gotten a bigger and bigger share of wallet, and so dining at home has essentially been on a decline curve. Well, of course, for obvious reasons, COVID's changed that. Interestingly, companies are still pushing for, or consumers, I should say, are still pushing for convenience, variety, value for money, and companies that are delivering that through the meal kit space are really booming. So too is e-commerce delivery in the retail chain. We've seen companies, again, like Good Eggs, that is an e-commerce delivery platform, see 2-3 years worth of growth in the last 6 months. So while if you were selling restaurant technology, you might not be feeling so great, those that are actually directly selling to consumers are really seeing huge upticks in terms of both valuation and in terms of actual revenue. And other interesting segments on the processing, packaging, food waste, supply chain management, companies like Appeal, for example, have seen huge interest in improving shelf life. In their case, they're particularly focused on avocado, but shelf life and reducing waste through the food supply chain. And novel ingredients, companies like Brightseed and Galtor have also closed, tens of millions, or in Brightseed's case, close to $100 million round. Again, focused on how do we deliver nutrition or greater nutrition and health through the food segment. So extremely diverse and hotter than hot right now. Let's go to the next slide. Another driver in terms of the swing towards food tech investing has been exit activity. Probably no surprise to anyone on this call that the life cycle of building viable, EBITDA positive, companies in AgTech is a longer life cycle, and again, a big part of that is B2B and also selling into more conservative customer bases and ecosystems than is the case with food, which is driven, as I said earlier, much more by B2C and frankly by often very, very rapid ramps. If we look at the exit of Beyond Meat last year, that was the most successful IPO of 2019. They've taken a few hits recently, but continue to be trading, something in the region, I believe, last of about $11 billion market cap. Went public with a market cap of $3 billion. And, I think for some of the early stage investors in that company represented more than a 50x return on capital. So the space is one that is getting consumer traction, and that in turn is leading to opportunities for those companies to go public, even though both Beyond and Impossible are still not profitable, despite having multi-$100 million revenue numbers. It's an area where we think New Zealand and Australia have enormous opportunity, in part because of both countries, very significant traditions as food producers, not just as farmers, but as major exporters, and with proud track record of innovation. But I would say the negative is that both in AgriTech and FoodTech, this boom that's been occurring here in investment has largely passed both countries by in terms of total dollars deployed. And it is not a lack of capability. So you have to ask the question, and maybe we will get into this when we do Q&A, why is there not more activity capturing a bigger share of wallet from this investment space? We feel confident that that will be something we'll see more of, but there's no question, I think, that while we're discussing, what is positive news, I would say generally, especially in New Zealand, the work being done with New Zealand Growth Capital Partners and Elevate, the rising activity we're seeing from the angel networks, the entry of companies like LIC, Fonterra, Gallagher's and many others into making more bets themselves into startup companies. That's all great, but there is a much, much bigger pool of capital that we don't seem to be accessing yet, and which I think is available for world-class technology and teams. Let's go to the next slide here, if we could, Candice. So we just wanted to take a few minutes here just to quickly give you a little back, for those who don't know us, a little background on Finistere and I guess partly why we're on this call today. So we are a venture firm that's investing across both seed through growth stage. We've made a number of investments in New Zealand technology-derived companies in AgriTech over the last decade, starting with ZCal, but including some companies you may know like Biolumic, more recently Invert Robotics, and companies with substantial New Zealand DNA in them, like CropX. So we're typically writing checks at the $2 to $6 million US range, I would say, in first checks, and then following on from there through subsequent rounds. I sort of wanted to flash this photo up just for the Australians who just didn't feel like this was a Kiwi-only party, because Spencer Morn, my co-founder and partner, is actually a true blue Aussie from Melbourne, although he runs our office in Silicon Valley these days. Can we go to the next slide? Just a snapshot of our team. So we also have presence in Dublin, Ireland, in Tel Aviv, and now actually, I have to say, in Palmerston North in New Zealand with Dean Tilliard. Really, I would say a couple of things about our team. One, that we're very focused on really understanding the technology advantage in any company we invest in. It's table stakes for us that they have great teams. That's a given. Every VC will tell you that's what they're investing in, and that's true. But the differentiators for us are, one, deep technology advantage. So is there really a significant either IP mode or capability this company has that makes them potentially a world-class and even a platform technology company? And then the other aspect we're looking at is, where is there significant publicly funded research that has done a lot of the heavy lifting on the science, but needs capital, expertise, and networks to be able to break out. And this is one of the reasons why we've decided to have a strengthened presence in New Zealand and sort of in the Australia-New Zealand region, because we think that what I've described maps really, really strongly to the region's strengths, and we think there's just huge potential to unlock a lot of value in commercialising science, out of the sort of the trans-Tasman linkage between Australia and New Zealand. Could we just go to the next slide here, Candice, and then we're just pretty close to wrapping up. So one of the investments we have made was alongside Finistere and long-standing co-investment allies of ours, our crowd from Israel, and Sprout Agritech, which we made earlier this year. Could we just go to the next slide, Candice? So I'm sure most folks on this call will have heard of or have had some engagement with Sprout, but it's sort of a key flag in the map for us in expanding our strategy in New Zealand and Australia from one of more ad hoc or really opportunistic driven investments into having a more programmatic and strategic presence in the region. I keep telling my team it's not because I'm a Kiwi, it's because there's world-class technology and teams down there and there's great people to co-invest alongside, although it doesn't hurt that I'm a Kiwi from that standpoint. But we think the business opportunity stands on its own merits. And I think a great example of this is the New Zealand government's initiative with Callaghan Innovation in developing a incubator program for AgTech and FoodTech. We, as I said earlier, have co-invested alongside Finistere and our crowd. Sprout have been going for a decade, so have a lot of fantastic corporate partnerships and partnerships with government. But essentially, we're looking to invest around 40 investments. So I would suspect it will go from anywhere from 40 million Kiwi to easily double that number with co-investment dollars from us and from our partners. It won't just be, by the way, Finistere and our crowd and Finistere investing. We, with help from Peter and others in the Agritech NZ ecosystem, have brought, I think, more than 45 investors over the last 5 years to New Zealand with us to get a sort of a taste and a sample of the opportunities that are there. Some of them, like Canopy Rivers and Rabo Ventures, amongst others, Yamaha, have co-invested alongside us, and the company's already in our portfolio, and I expect to see a lot more activity. In fact, I'm sure everyone on this call will agree, Australia and New Zealand are, I think, to some extent underrated and to some extent, not well understood opportunities in the global investing sector. And I think as breakout companies continue to come from the region, that will change. And I guess just to say to everyone on the call here, we're very much committed to helping be part of that narrative and to, frankly, putting our capital, putting our money where our mouth is on these deals. So that's it. I'm going to stop at this point and hand back to Brendan here and Peter for any questions or Q&A that you'd like Ingrid or myself to cover off today.
Well, perhaps, Arama, first of all, just to thank you and Ingrid for such a detailed presentation. Really encouraging to see the numbers and really interesting also to see the kind of sectors which are attracting most interest at the moment. So just to remind people, first of all, on the call, if you've got questions, please place them in the Q&A facility at the bottom of your screen. That's how Brendan and myself will be moderating the Q&A over the next 15 to 20 minutes. And whilst you do that, I'd just like to take you back, Arama and Ingrid, to the webinar call we had in April. New Zealand at the time was in level 4 lockdown, and we all felt that the world was falling in on ourselves. A key focus at the time, I remember you saying, Arama, was that for VCs, a big focus was on the existing portfolio of companies rather than new investments. And I think at the time you were talking in terms of seeing how existing portfolio companies could extend their runways to the end of 2021. And I'm just interested to find out, how successful portfolio companies have been at extending their runways, or whether the availability of capital has actually changed that dynamic and people may actually have increased their speed to market in terms of trying to acquire new capital.
Yeah, I think it's a bit of both actually, Peter, and Ingrid may want to weigh on this because she led one of those efforts recently with Biolumic, New Zealand company in that respect. But on the second part of your question, I think the increased capital availability is definitely flowed into sectors that are growing and growing positively. So we've seen crop protection, for example, indoor farming, as Ingrid pointed out on the agriculture side, received between them, over 50% of the total capital raised in the current year to date. We've also seen on the food side, companies catering to dining at home see really spectacular growth. I mean, one of our companies has increased, their revenue 500% through the course of this year, driven by that trend. So that kind of growth is attracting a lot of interest in capital. I would say on the funding of companies on sort of a insider rounds supporting companies. I mean, we're close to completing that process, and we will have funded all of our companies in our portfolio this year as a result, so 100% of them. But it's been very much down to having, well, I think some great companies, obviously, but also fantastic syndicate support. I would say most of our VC colleagues now rate syndication, who do you actually co-invest with, as being almost as important as which companies and teams you support.
Yep.
Okay, so Ingrid, I mean, what are your observations, around the insider process, given you've led a few of those this year?
Yeah, I think, trust in your co-investors has been huge. I led a panel at AgTech Next, chatting with other investors around how they've dealt with the process of looking at either doubling down on investments or looking at new investments within AgTech. And unanimously, everyone said that they were relying quite a bit on, syndicate partners who were actually on site or knew the companies well in order to drive these decisions. Now, across our portfolio, I would say that, it was a little bit bifurcated in terms of capital requirements. When we took a look at companies that were founded, earlier on in the AgTech boom, closer to the time that we had the 2008 financial crisis, and fundraising was tough, we found that, when we looked at those portfolio companies, they had ample runway to make it through COVID, right? They were kind of built with a different DNA in a time where it was difficult to raise capital. So that it's been interesting to see the difference in our portfolio between companies that were founded in lean times versus the ones that were founded in the midst of the AgTech boom, where capital comparatively was easier to access.
Thanks very much for that, Ingrid. I'm just going to turn to Brendan and ask Brendan whether he'd like to just ask a couple of the questions. Some great questions, incidentally, coming up on the Q&A. But Brendan, if you'd just like to kind of take a look at the Q&A and ask a couple of those questions, that would be great. You might need to take yourself off mute.
Yeah, I do need to take myself off mute, and that took a little bit longer than it really should. So there are some good questions coming through. So in no particular order, Arama and Ingrid, what in your opinion is the reason that we're maybe not capturing a bigger share of the capital pool or wallet in the food tech space in Australia and New Zealand?
Yeah, I can take this one if you like. Look, I think one very obvious answer is it's hard for people to invest in you if they don't know you exist. Right? So visibility is important. I know Agritech NZ in particular has done a lot of outreach work. But of course, we frequently now are bumping into more Australian and New Zealand companies in the major ag and event conferences. Those have now gone virtual. So visibility, I think, is one of the key questions or challenges, frankly. And also, how does the local investor base in Australia and New Zealand help connect the dots? Because often, indeed, as we know, in New Zealand in particular, it's often angel groups leading early stage capital formation. That was certainly the case with Biolumic. When we invested in Biolumic, we were the first sort of institutional money in, and we brought the other investors with us from our network into that company. So, I think looking at sort of, the data set of companies that have been successful, what have they done differently to both make themselves visible and take a full advantage of all the support from government, from the Austrades, the NZTEs of the world, the Callahans, as well as major conferences and industry associations like yours, right? We're looking for deal flow. And I think that the other thing I would say for us that's made a difference is putting a presence on the ground. It's pretty hard to write a check if the company's domiciled in another country. I mean, some of our colleagues won't even write checks to companies that aren't in the same city.
Yeah.
It's like, you want a check from us, move to Silicon Valley. Well, great. I did my burn just went up % as a result.
Yeah,
Probably related to that, Arama, just, you know, in terms of you mentioned earlier, sort of the face-to-face barrier and looking at maybe making investments with people that you actually haven't been able to shake a hand with yet. You know, are you seeing, what are you seeing that works well in that space, or that would help you be able to actually get across that barrier?
Yeah, I mean, we have a VC group of about 20 other VCs that we do a 2-weekly call with, and one of the strategies that we're frequently discussing is, hey, does somebody else in the group know this company, or is somebody else an investor in a company and we're not? And so that you know, the common thread here is that the only thing scarcer than capital is trust. So, you know, how do you build trust remotely and at distance? And one of the ways is you get other people who vouch for the company. You know, so if a group like, you know, Big Angels, for example, who we've worked with in Palmerston North, comes to us and says, hey, we've vetted this with Dean, we've vetted it with other partners here, we think you should take a look at it. Well, we will. And it's just an example to say, I think the same is true in the Australian ecosystem. There are some really great firms there that have built international networks. Obviously, you know, Blackbird just recently announced an Elevate related fund, you know, great credentials in the Valley and their verticals. So, you know, leveraging off those relationships is pretty important. I also think we're getting better at figuring out how to do due diligence remotely. So, I mean, for example, Ingrid's probably looked at just about every, you know, biological or crop protection company out there. If there's someone out of Australia or New Zealand who's looking at that specific space, our local team's going to get on a Zoom call with her on that topic and really see, you know, do you cut the mustard or not?
Yeah, I think backing up a little bit to the, you know, capital capture issue, I think it's twofold, right? It's one, connectivity with firms that are willing to write checks, as Arama said, or that know you well. And then the other side is understanding what's happening in the broader market. I know here in Canada, within our startup ecosystem, there's often a challenge with, you know, ideas that seem new here in Canada, but, you know, there may be an existing universe of companies already, you know, going after that market that could easily, you know, just kind of port their offering into Canada or into New Zealand or into Australia. So I think the flip side of, you know, being involved or connecting with investors who, you know you and trust you, is, you know, connecting with investors early on in your fundraising process who know what's going on in the broader market, who can give you pointers as to whether or not this is a truly unique idea. So, you know, if it's not, you can move on to your next thing or tweak your idea so that it can be unique for your market, or, you know, try and figure out something new. Because I think understanding in the global context of, you know, what's happening in the ag and food market is really, really important. Certainly as investors with a global focus, you know, that's the measuring tool that we use to evaluate companies. And you know, I think any investor worth their salt will be doing that as well. So talk to us and talk to us early.
Okay. That's sort of related to another question here, Ingrid, around, you know, what are the key metrics companies should be seeking to benchmark themselves against when they're trying to pitch to global capital in terms, is it APR multiples, growth multiples? What are the type of things people should be focusing on and thinking about?
Yeah, Ingrid, do you want to take that one?
Yeah, sure. I think the answer is, you know, that depends, right? It depends what kind of company that you're building and what type of technology you have. I think if you're a company that's a B2B company, you know, certainly your technology is ready to go. You're at proof of concept. You know, we'll be looking at things like what your customer acquisition costs are, you know, what the lifetime customer value is on the food side for, you know, any CPG company, metrics like that. And then, you know, what the growth rate of your sales are, what your customer retention rate are on that side. On the life sciences side, you know, for companies like Biolumic, like Zcal that we've invested in, you know, that come from New Zealand, it really has to do with, you know, what the technology market fit or the product market fit will be. Do we think that once your technology is de-risked, it fits the market, and then figuring out what the tech and regulatory risk will be. So, depending on where you sit within the agri-food, value chain or stack, we'll be using slightly different tools. So as we, said right in the beginning of our presentation, ag is, a horizontal of a whole bunch of different segments that have different business models and different needs, and that absolutely holds true. The answer is it's complicated.
Yeah, sure. Slightly different angle here on one of the questions that might be interesting to hear what you're noting around the world as you're looking at these things. Do you think farmers or growers are seeing higher returns as a result of some of these investments and market changes?
Definitely, in specific segments. So if we take alternative protein as an example, in the last 5 years, there's been a huge influx in building pea protein extract facilities, actually mostly in Canada, because guess what, the Canadians are pretty good at growing peas. And the most recent of which was like a nearly $250 million facility built by Rockhead. There must be at least 10 plants under construction at the moment. And so how are growers making more money out of this? Well, their products in hot demand from the consumer. Pea protein is a critical ingredient in the products marketed by Beyond, Impossible, but a raft of other companies, including companies like Ripple, that are one of the top performing alternative dairy protein companies. So guess what? Growing what the market wants, and the market responding in a way that has really not been seen for a long time. I mean, innovation is driving really pretty substantial growth opportunities in this area. The same is true for sustainability. So we're starting to see sustainability premium being paid to farmers who can, I think I saw a question here around blockchain, for example, but the ability to follow through the supply chain and show the provenance of what it is you're growing. The increasing interest in life cycle analysis, for example. We're seeing that obviously in New Zealand and Australia, actually amongst so is Ireland actually, some of the forefront players in the world at really figuring out how do we demonstrate a more engaged approach to the environment and to consumers' environmental concerns and the product that's produced. All of the major food companies, the top 20 food companies, all of them have changed their chief executives in the last 5 years. And it's because they face unprecedented challenge, but also the best of them are going to capture huge opportunity as a result.
Yeah.
And guess what? Savvy farmers are going to figure out how to utilize that trend. The last point I just make on this too is that there's also existential threat posed here. I think there's a question here around, cellular ag, what sort of opportunity or threat does that pose to traditional livestock producers? Well, if it works, it poses an existential threat. Maybe not, someone joked to me the other day that Ford may not go out of business next year, but if things continue as they are in the EV world, they'll go out of business in 20 years. And in February, I was speaking at a conference in Dublin, actually, held by the Sovereign Fund there. And they said, well, what's the biggest threat you see to agriculture? And I said, well, cellular agriculture to dairy, there could be no dairy cows in 20 years. And the chief executive said, well, I was asking you to give a memorable quote. Maybe that one went too far. But the reality is that technology does pose a huge lever for agriculture and food, but it also poses an existential threat.
And do you really think it is an existential threat, or changes the? I mean, obviously, it's going to have a big impact, but does it change the place of what so-called natural food might be looked as sort of what would become a scarce commodity compared to other food systems, which will likely be cheaper and meet many of the consumer requests? Does it just sort of place a different value on those natural food systems?
Yeah, I think it's a great question. I mean, I think it's one of the questions that producers and their marketers, and so companies like Finistere, for example, or Zespri, that's made, I think, a great fist of the question of what does the consumer want, and how do I produce snackable, nutritious, craveable, available produce, for example, which, as Ingrid noted before, the indoor ag boom that's going on here is because we have a shortage of places in the world where we can grow produce to the quality and standards necessary. There's only like 5 places in the world which have Mediterranean growing climates. Australia and New Zealand happen to have between them segments of that, which is super helpful, but it's not anywhere near enough to supply the growing demand. I mean, what are the 2 things consumers want as they get richer? They get hankering for protein, and they want fresh.
Yeah.
You know, so two pretty, I think, look, not to be a doomsayer, I think our own bets reflect the fact that we think improving existing agriculture and food supply chains is important, but we're also betting on the disruptive.
Yeah, it's a double whammy. So I think the approach here in terms of New Zealand's focus on a fit for a better world stands up as one part of the strategy. And I guess what you're saying is there's other strategies and other investments needed on top of that as well.
Yeah, absolutely. Yeah.
Cool. Well, listen, we've already tipped over time, and I know some people are going to need to get away. So can I just thank you very much, Arama and Ingrid, for a really insightful session. We've got questions still coming through here, and I'm sure that'll continue. So look forward to maybe a future event with you guys and to keep the discussions going. Thank you very much, Peter, as well for helping us out here today and for making the introductions. Quick plug, of course, for some of our local partners here. The Sprout Agritech 2021 cohort registrations are still open, but I think closing in the next 24 to 48 hours. So if you know anybody who needs support and acceleration in that space, that's the team to work with. So get your registration in pretty quickly. Also, of course, the Innovation Awards at Field Days are getting up and ready for next year. So make sure you go and celebrate some of your successes by keeping an eye on those rewards and going forward. And here at Agritech New Zealand, we have a couple of opportunities to meet in person, which we're very grateful to be able to do. So we do have some events coming up in Christchurch and in Auckland next week. And then we'll be having further events around the country in the new year. So thank you again, Arama and Ingrid. Great session today. Really good to have you with us. Thank you, everybody, for joining in. And we'll look forward to seeing you all again soon.
Cool, Brendan. Thank you.
Take care.